Hey everybody, it's been a while since I made a video. Today I'm gonna be talking about current market, and I had a lot of client and friends asking me whether right now is a good time to invest. Uh, Instead of giving you a quick commentator, I made this video and with some reference, so for you to do your own research, right? Don't just take my word for it. And I hate to be honest, I hate to make commentator about the stocks. There's nothing good about making comments about the market in general. Because if you're right, yeah, but if you're wrong, you're basically sticking your neck out, right, for to the chop. So, so this is pretty much my target audience are my close friends and my client who really want to understand the thought process behind um, my take on the current market is. Okay. First thing first, if you go to my website, HY Financial, under More, there's Form. Click on Form, and I made a post in regarding to today's video. So if you go to Form, you go to HY Open Resource. There's only two posts on this. Uh, it's this first post, when to buy stocks using common stock indicator basics. You see that I made this 21 minutes ago. And if you click on it, and I briefly go through, this is really talking about when to buy stock, whether right now is a good time. But another question is what to buy, right? And I think that's a little bit more complicated uh, question. It really depends on your personal interest, right? Your set of knowledge, your what's your risk criteria and all that stuff. But for the basic audience, I think the most widely recommended is to buy the SP 500 index in a low cost ETF. Here I mentioned about VOO. Oh, I didn't put the symbol in there, but SP 500 Vanguard Index ETF. Vanguard is VOO. You will come to check that out. Oh, I need to make a quick disclaimer. So, I so none of the future or none of the past performance is representation of future, and also none of the recommendation or I'll be expressing in this video are don't hold me liable to any of the comments I'm expressing throughout this video. Okay, uh, you can take it with a grain of salt. The decision to make any actionable trade or decisions is solely upon to you. Okay, so this video is really about when to buy and more specifically whether right now is a good time to buy or not. The way I look at this question is from two perspectives. One is qualitative, well, that's a typo right there, and the other one is quantitative. I think I switched. So quantitative means what is the economic backing on the current condition? Is that sound, right? What's the valuation look like? Are you within margin of safety? For that, I referred you to a couple links. One is this first one from Guru Focus. There's a couple chart in there. Close this. So it's this first chart right here. It's total market cap to U.S. GDP. Over the years, I've been doing this over 20 years now. Over the years, I find this gave you the most reliable information in terms of our valuation. Throughout this chart going all the way back to 70s, I think, 70 to current 2020, historically, this green line represent the current GDP. This blue line represent the total market cap of the stock market. And here we use Wilshire total market 5,000. Um, there's a way you can do it by yourself. You just Google search Wilshire 5,000, and then you can plot that against the current GDP, which give the same chart. This is just a lazy way to do this. Normally, the ratio is anywhere from 60 to I think 140% in range of this green line. The blue line reference to the green line. 60% means it's 40% below. 140 means 40% above, right? Normally, for my margin safety, I like to buy within the 100% ratio, meaning historically or less than 100. This hasn't really hit a whole lot in the past 2 decades because the low interest environment. But at the 100% level is when they intersect. So this point, this point, this point, this point, they're relatively safe, right? But you can see this is still at the peak. So one of the things you have to understand about indicator is they can only provide some sort of reference, right? There's going to be many indicators. I'm going to show you a couple of them today. There's many of them. Some indicators give you some idea. Then if you look over a range of all the indicators altogether, does that give you a line? Does that give you the same story? If it doesn't give you the same story, maybe you're off. You're better off not doing anything, right? I only act when there's a strong indication of either overbought or oversold. When there's a significant margin of safety, that's when I buy, right? When I sell, it's when I see there's a fundamental issue with a company or the underlying economic, like current crisis, right? So this is one indicator. Anything above is the intersection, or just say 120% above, I think it's fairly overvalued in terms of valuation. So this is just a historical comparison between the total market cap versus the GDP. Okay, so take a step back, right, to see, hey, does that indicator make sense, right? Because your total GDP should include all the import, export, domestic, all the economic activities, right? All the domestic products. So market cap, stock, how well the stock is doing represent a portion of it. So there should be some sort of correlation throughout history, right? And this is the historical chart that we have. They have the graph. And there's a couple other ones here, like the interest rate. Of course, right now we're in a very low interest environment. That's why you see a much higher valuation. I don't really pay a lot attention to the other ones. There's so many of them. Long-term corporate probability, market valuation. You can take a look at these on your own time, and you talk about a little bit more about how you should look at the investments. Okay, so I want this link. Basically, I want to show you this chart, and the next link is the PE ratio. More specifically, Robert Shiller PE ratio. So normally this PE, so PE is price over earning. So how much are you paying to have an earning of $1, right? So a PE ratio of 15, that means I'm paying $15 to get an earning of $1. Currently, we're paying $25 to get earning of $1. So what that means, if you think abstractly, means it's going to take me 25 years to make my money back, right? Because I'm paying $25 to earn $1. It's going to take me 25 years. With discount rate and everything else, opportunity cost, that's not a very good return, right? We won't go over PEG, but historically, just knowing this chart, it's normally around 15. That's actually our safe bet, 15. So that's right here, right? Again, I mentioned earlier, because the low interest environment, everything has been inflated. So 15, the last time it hit 15 is 2010, you know. Prior to that, it's 1990. So because of low interest rate, it has elevated this PE ratio a little bit. But still, from my perspective, I like to be in the 15-20 range, right? If I see a stock that's like 40 multiple, I'm probably not gonna buy it, even though they may have high return. That's okay, because the first rule of investment, if you listen to Buffett, is to don't lose your capital, right? And your second rule is to remember the first rule. Okay. So anyway, this is the second chart, very nice chart. Again, this is a very basic level, so you can have some sort of a um, mental notice to yourself as to how the economy is doing. And then this third tab is the general public available information on economic data. So you have all the confidence, consumer confidence, employment trend. You see minus 44, and there's all the world economic indicators, and there's much more on this site. So this is a good resource. This and the Census Bureau are a good resource for you to go to get the current economic data. Okay. So that's your more of your valuation. Hey, how is economy really doing? But regardless which chart you look at in this top section, these are the chart only shows the current environment, right? And sometimes they're a month or 3 months behind the current timeline. It's not really forward looking, right? So the forward looking part, how well do you think the economy is going to be doing in the next couple of months? It's really, you got to put a little thought into it, right? You got to put a little thinking cap, put your thinking cap on. You got to think a little bit. When we had the crash, all the crash up till now, all the stock market crash up till now has been exacerbated by fear, right? There's some sort of fundamental element, whether it is the financial crisis, the mortgage-backed securities, or the dot-com bubble, right? Or the oil crisis, whatever the case may be. There's one layer of the fundamental crisis, and then there's a fear factor, right? Together, that probably account for majority of the crash. But in our current environment, so I'm speaking today as of April 21st. Okay, we just had a little bump in the market. Right now, we still have half people doesn't believe coronavirus is a fact. A lot of people still think it's a hoax. A lot of people still think it's a flu, right? We haven't really get over that kind of realization yet, right? Even though now the media finally start catching up, right? You finally start wearing your PPEs, your social distancing, okay? A little behind, but the media is catching up. But even if we're all caught up on the coronavirus, we still haven't got to the domino effect, the economic impact due to the coronavirus, due to the social distancing, due to people unable to pay their rent. So, I have a relationship in a couple of small business and in rental properties, right? And in real estate, I know the housing market is gonna take a dive because there's gonna be less demand because people aren't going to be looking houses, right, during this time, and there are going to be a lot more supplies. If people are dying, you can bet there are going to be people selling houses. If people can't have jobs, unable to pay their mortgages, right? They might be thinking about selling their assets. So I think the supply going to increase, the demand going to decrease, right? Because again, you're going to have less buying power, right? The demand going to, so that's not going to be good for the real estate market. And then you have all these small business. For my small business, we're not getting revenues on my business, right? Even though we're not getting revenues, we're still paying all the expenses. Luckily, the business we're in will have some reserve cash, right? Reserve capital that allow us to burn number of months. But there's some small business that live paycheck to paycheck. Think about how vulnerable they're gonna be, right? Think about how vulnerable the labor market is gonna be, right? There's gonna be a lot of people claim unemployment. So we haven't really seen the effect of all that real economic crisis, right? And I think that's going to be multiple X amount of multiple fold worse than any of the previous um, prior crisis. And then once the fundamental issue surface, then there's also fear factor, right? The fear factor only going to multiply by magnitude. Okay, so I think those two core components, the fear factor of the crisis, the after effect crisis, and the after effect crisis itself, those two components has not been priced in because we still have a lot of non-believers. Oh man, I wish they didn't came out. Okay, all right. So those are the valuation part, and then and there's a lot more we can talk about on that, but that's just your basic indicators you can take a look at. And then you have your qualitative, right? That's you're looking at technical chart. I use E-Trade because I already have all my template on my chart um, on my template. But if you don't have it, you can use Big Chart, this second link, or you can use Yahoo. Yahoo is getting a little bit better since Google Finance has been, like they pull the finance out from Google. So I use E-Trade, right? So I have this E-Trade open. Let me show it to you. Just kind of give you an idea of what the current chart look like, all right? So first, let's take a look at overview, like overall, historically, what is happening. I'm gonna make this go as far back as far as possible. I don't think it can go 60. I don't think there's enough data for 1960. Yeah, but basically, let's keep 70 here. But basically, you see that you see couple trends right away, right? From 1972 to somewhere right here, it has been a kind of steady slope, right? And then from here maybe to here, this section here has been fairly flat, right? I mean, it bounced back and up, but this trend line has been fairly flat. And then all the way from 2010, you have this straight up. And that slope, just kind of picture this in your head, right? Is this sustainable, all right? Can this be backed by economic data, right? If I'm saying 1,000 here to 3,500 here, 300%, 3 times in 10 years, in terms of GDP, can we triple our GDP in 3 years? That's hardly the case, right? So same thing with stock market. This slope cannot continue, right? So I realized this last year. I mean, like last year, I thought it was at a I think in 08. I mean, in 2018. Sometime in 2018, I had to go back to my email. I issued a letter to my close friends and some of my clients, especially for people that have TSP. I asked them to reduce their TSP hold from 100%. If you're in 100%, maybe move only 50% into stock, 50% into government securities. So historically, just realize we're in this very high inflated market, especially at this point. So it's no wonder the market gonna crash and crash back to revert to the mean, right? This line right here, this light blue line, is your 200 moving average. What moving average is taking the average value of 200 days and plot that. Gosh, I need to close that notification. And then you have smaller moving averages. You have the 50 and 20. I'll go a little bit deeper on all this indicator, but I just want to give you the historical view, okay, of the overall market and what that look like right now. So you drop from here to here. All right, let's take a look the 3 years. All right. So one thing I did say here, All right. So for technical chart, I like to look at MCAT, RSI, EMA 250/20, 20-day moving average. I'll show you what those things are. The chat pattern, whether you probably heard the famous shoulder head shoulder as reversal. There's a lot of other patterns. You can Google that. Supporting volume and your VIX. Okay, so that's what I use. You're welcome to Google each one of those terms to get a little bit better understanding. This is just meant to be overview, just broaden your awareness of what's out there. Okay, so let me go back to my chart. Where is it? Okay, this right here. All right, so so this is the reason why I use E-Trade, because I used it for 20 years, 15, 20 years. So on top you have the EM moving averages, 250/20. Here you have the VIX. Okay, I also put a link here. If you don't have E-Trade or you don't have a chart that's showing VIX, you can click this link and to get your VIX. Okay, that's your VIX chart right here. All right, so coming back here. Okay, this is your volume. Okay, this is your MCAT. Basically, you're looking to see whether your MCAT and your EMI, whether they're convergent. And this is your RSI. This is looking at the relatively closing price, and that will show you whether it's overbought or oversold. Okay, again, Google the individual terminologies, but this is a common indicator that I use. So without looking at the chart, if you give me any chart, without looking at the chart, when this VIX goes up, it means there's a lot of volatility. That's what VIX means, volatility indicator. There's a lot of volatilities. Normally, when there's a lot of volatilities, there's a lot of fear. When there's a lot of fear, that means people sell stocks, right? So normally when this peaks, there's a couple places where it peaked a little bit relatively. So if I go up, there's a drop, right? Here, if I go up, there's a drop. Okay. All right. So here, obviously that's a big drop that we had. Okay. All right. Then this MCAT and EMA. Okay. By the book, it talk about when the MCAT cross over the EMA. That's when it triggers a buy signal here. Okay. But I don't really like that. I look for the gap, where it's farthest. So the bigger the gap, I know they're going to converge, and I will buy here versus buy here. Okay, and then the oversold. Okay, once in this general area, that means there's a lot of people been buying. So who's going to sell the stock, right? So that means overbought. Okay, in this area, and here it means oversold. Okay, so here in this range, tell you probably want to buy here. Okay, if you buy here, you bought it too early. Okay, so one of the things you have to keep in mind about indicators, especially technical indicator, is don't look any one of them. Okay, any one of them could be wrong, but if you look everything together, does everything tell you the same story? Okay, the more indicator tell me the same story, the better I can rely on that information. Okay, all right. So that's a quick view on the technical side. And the reason I don't recommend people to buy it now is first I only like to buy or sell when the indicator tell me to do so. Okay, if I want to buy anything at all, I would have bought it here. Okay, when all of these indicators supporting my thesis. You have very high volume, you have high VIX, you have a kind of gap between MCAT and EMA. You don't have so much of a RSI, but RSI was oversold just a couple of weeks ago. And then you have this big drop, right? We don't know when you buy a falling knife. You should not catch a falling knife, first of all. But when you buy a big drop like this, you don't know when it's gonna end, right? Henderson size 2020, you know it ended right here. But When it's falling down, you don't know when it's gonna end. People with less emotional tolerance, they're gonna sell off of fear, right? But here you see it's a large gap between each of the EMI moving average. So 50 between 20, there's a gap here. This is 200, the yellow. There's a big gap right here, and the actual is even farther below the 200 moving average. So what does that really mean? That means, think about it. So say overall, there's only 10 sellers for the last 200 days. Okay, and all of a sudden, did I say 20? I say there's 20 sellers for the past 20 years, or for the past 200 days. Then all of a sudden, from 20 sellers, you're gonna have 200 sellers. Okay. People that's on the other side of the trade, they can only buy so much. There are only so many buyers. Once all the buyers fill their trade, who are left to buy, right? So that's why when you have a significant drop in compared to your average, okay, that shows somebody really want to sell, but there's only going to be enough buyers, okay. So that's why this EMA makes sense fundamentally, okay. All right, so that's why so in this let me do a 1 year chart. So you see the lowest point is here, which is March 23rd. Okay, the day before is March 20th. Okay, that's over a weekend. Now, I normally don't do this. I normally don't send an email to my close friend and my colleague telling them, hey, if you want to buy it now, go ahead. You can go ahead buy 10% of your stocks. Okay, I issued an email to some of my colleagues and client. Let me show you here. Yeah, I sent this email out, BCC'd myself back in March 19th, just 2 trading days before the lowest point. How did I know that? Well, I knew that because I was looking at this chart. Okay, so I sent this out to everybody. Now, I do want to explain this email a little bit. Hopefully some of my clients listen to this, the recipient of this email. So for your retirement account, for your TSP, for your 401k, right? You should not be moving that money all the time. You should not do a lot of transactions. So generally, my range is between 50% stock all the way to 100% stocks. Normally, it's always in 100% stocks, unless I see a crisis in the foreseeable future. Okay, like it happened in 2018. So I sent a first email to a lot of my colleagues in 2018, tell them hey, I think the market getting pretty high. If you have 100% in your stock, go ahead and move to 50% in stocks, right? And then 50% in government security, the G fund. This is talking about TSP. TSP is a federal employee retirement fund. Okay. But understand the point I want to make here. Understand my lowest stock allocation here is 50%. You can go to 0 if you want to, but I always want to be into the market a little bit because I could be wrong too. But if I'm wrong, I only lose the 50% upside. But if it drops, I'm also saving 50% of the downside, right? But because my indicator before, I feel pretty strong to issue that comment to my colleague, to my friends in 2018. And if you'd done that, you would have saved 50%, right, of the drop in the current crisis. And then in this email, I explained, hey, I think the crisis is gonna continue on for a long time. It's not gonna be an immediate bounce. I don't believe that. It's not gonna be a V curve. So I say, if you want to invest 100%, the remaining 50% of your money back into stocks, okay, then do it in small increment. March 18th, March 19th, that was a good time to invest some of that. And I share the folks, hey, go ahead and invest 10% if you want to, right? And that's what I did for my personal account. And you can see, well, it used to be 50% here because everything dropped. This bounces up. But before the allocation is 50% allocation. I think it's 50, 15, 15, 20. I believe that was my allocation. Yeah. Common is 20. Small cap is 15, and international is 15. Small cap get hit really hard. That's why it dropped a lot more. Because both is dropped, the government fund increased. But the allocation was supposed to be 50, 20, 15, 15. And then per this email, I ask folks to go ahead and move 10% from your G fund to your common stock. Okay. Now, this contradicts a little bit about what I said about, hey, the market maybe in a bear market, right? We are in a bear market, but it might going down even farther. But that's okay too. But that's why I'm asking only put 10% into the stock at this point. Okay. All right. So long story short, this is kind of just show you that allow me to explain this letter to my client, and also tell you why this indicator works. Okay. It doesn't work all the time, but for very strong signal, over the years, I tend to find it that it works. Okay. All right. So, couple big takeaways. Just come to my website, hyfinancial.com, click on home, or if you are at home, go to more, form, this open resource post, and here you will when to buy stock, and here you will see all the indicators. The top part is really your qualitative, and the bottom is your quantitative. I'll switch the typo there in a minute. So here you look at the fundamental economic indicators. Here you look at technical indicators. Okay, together maybe it give you a better awareness on when to participate in the stock market. Okay, all right. And one other disclosure I like to make is I rarely make trade. I make trade about a dozen times a year, and that's it. I don't like to make going in and out of the market. I don't make a lot of trade. I only do big trade decisions when there's a very strong indication about something that's going to happen, both from qualitative and quantitative perspective. Okay, and 2018, I felt the market is kind of high, so I asked people to start moving some of the money into safer investment. For my client, not a TSP. TSP is just more of a comments for my friends and colleagues. But for my client, I really went ahead and moved 50% from their stock allocation into whether it's money market, cash, or very safe bond fund. Okay, and then now it's when you start looking at, hey, how to put money back into the market. And my recommendation is don't put in right away. Don't put 100% your available cash into the market right away. Look at your indicators to pick the right time. Don't do it any time. There's only a couple of days you should do that. That's when you have a great indicator. And then this is going to be a long-term process. Don't put all your money in one day. Okay, do a little bit by little bit, and every time the timing is very important, right? Because if you pick one day, you could be buying at 20% discount. You pick another day, you could pay 20% more than what somebody else paid just a couple weeks ago or a couple days ago. Okay, so my general thesis is that this is going to be a long process for us to recover, and we haven't even hit the trough yet, right? The peak of the crisis. We may get to the peak of the corona crisis, but we haven't hit the peak of the economic crisis, the after effect of what the coronavirus bring us. Okay, so if you have any questions, you can go ahead and email me at hy@hyfinancial.com, and I'd love to talk to you guys too. Okay, thank you.